So let's imagine for a minute, okay, let's imagine for a minute that we are going to take the position that this so-called transition tax should apply to, let's say, Canadian citizens who have the misfortune of having been born in the United States and happen to be successful small business owners in Canada, and then they're asked to fork over, 17.5% of the, what's on the balance sheet, of their company since 1986. I mean, this is just over the top.
Yeah. So look, I've prepared some slides here. Let's go through and look at the mechanics of all of this.
Great idea. But again, assuming this applies, and I hope you're all sitting down and that. I mean, this is really extraordinary stuff, and I thank you in advance for taking the time to put this stuff together. So here we go.
So, assuming this all applies to you, we've got this lovely Tax Cut and Jobs Act, which, like John said, is the really the Full Employment for Accountants Act. So we're going to start with the big picture. Okay, the big picture. This is more or less a paraphrase of what's in the law, and it's an awful lot of words there, isn't it? The tax code really, for some reason, legislators don't know how to write a tax code in plain English, because this is not plain English. But there are really three important concepts that we need to get out of this. The first one is who. So who is subject to this tax? The way the law writes it is U.S. shareholders of CFCs. So we'll unpack that on the next slide.
CFC meaning controlled foreign
controlled foreign corporations, exactly. So we need to know who they are, and really Congress wasn't thinking of non-resident shareholders when they wrote this bill. What else do we need to know? We need to know what they're paying tax on, or how much income they have to add to their tax return. And that's the post-1986 deferred foreign income. So we'll talk about what that exactly means. But basically, that's the $100 billion, or actually $250 billion, that Apple has stashed in Ireland. And then the third concept we need to get to understand is what's the tax rate we're going to pay. And so here it's really convoluted. What they do is they give you an offsetting deduction. And of course, the bigger the deduction you get, the lower the tax you pay. So we're going to make the deduction smaller if you've got a lot of cash and securities, because if you've got a lot of cash, you can afford to pay the U.S. some of that cash, right?
Can I just ask you to stop there for 1 second? I think that is such an incredibly important point. Because if we look at the shareholders of Canadian-controlled private corporations that are using these things as pension plans, they're more likely, to have cash or cash equivalents in them. So the effect of this, should it apply to these people, is that the greater the extent to which it really is a private pension plan, the greater the level of confiscation, right?
Right, exactly. The greater the impact, the more the cash there is. Okay, so they've set the deduction. They call it a rate equivalent percentage. I mean, again, they don't know how to speak plain English. They've set it so that corporations would theoretically be paying 15.5%. But as we said before, if you're paying at the top individual rate, that's actually 17.54%. And that's before we even add in anything for net investment income tax.
So again, individuals who don't get any of the benefits of this pay a higher rate, or rather have a higher level of confiscation than corporations that do get the benefit of this.
Yeah, but Congress was nice, okay? They said that you can spread it over 8 years, interest-free.
Well, that's I guess that makes it all okay, doesn't it?
Oh, yeah, not quite. Okay, so let's go through and unpack these three main concepts. First of all, who? So who is subject to the tax? It's U.S. shareholders of controlled foreign corporations. And like we said earlier, that these are defined terms within the tax code. So a U.S. shareholder is a U.S. person that owns 10% or more of a foreign corporation.
And that would include green card holders, right?
That would definitely include green card holders.
Yeah.
Any U.S. person, a U.S. citizen, a green card holder, U.S. resident of any sort.
Including those who meet the substantial present test, correct?
Yes, any resident. So substantial presence would be a resident.
Too long. So just imagine this situation for a minute. Okay, so you're a Canadian citizen. You have a Canadian small business corporation. You get out of the United States and you trip the substantial presence test wire. Then all of a sudden you're subject to these reporting requirements and the possibility of, this kind of confiscation, right?
Yeah. Well, this is a one-off tax. So if you trip this wire during the transition tax year, that's a real problem. Okay?
Right.
After the transition tax year, which is 2017, if you're a calendar year taxpayer, this only applies once. It only applies in 2017.
Okay, that's interesting.
Okay. So U.S. shareholders now, if you add up all of the U.S. shareholders in a corporation, and remember, you're only a U.S. shareholder if you have 10% or more, then if all of those U.S. shareholders own more than 50%, that's a controlled foreign corporation.
And by the way, on that point, a lot of tax preparers have these questionnaires they send out, right? And one of the questions that I often see is, do you own more than 10% of a corporation, or 10% or more, rather? If the answer is no, you could not be affected by this, right?
That's right. If you own 9% of the corporation, you're not going to be affected by this.
And if the answer is yes, you might be affected by it, depending on what else is happening with the corporation, right?
Depending on who the other shareholders are. Yes.
Right. My God, what if you didn't know much about the other shareholders and you woke up one morning to find to your horror that all of the other shareholders were U.S. persons?
Didn't even take all. It just takes enough to own more than 50%.
Oh my God! It's perfectly obvious with this going on that that anybody setting up a business of any kind has got to ask questions about the citizenship of the other people involved in the thing.
Well, and then this is happening in Europe. People are being denied business opportunities because they're U.S. persons.
Well, I think it makes a lot of sense. I mean, would you get involved with a U.S. person under these kinds of circumstances?
I certainly wouldn't. No, because all the corporation's information is going to go to the IRS.
Well, that's on the reporting issue, right? That's on the reporting issue. But if you've got subpart F income issues, somebody might say, well, it just applies to the one person, but where does the money come from to pay this tax? There'd be tremendous pressure, to pay out dividends, right?
Right. So that's who. Now, what about what or how much? So we're going to call this a subpart F inclusion because that's how the bills set it up. They've just used this subpart F, which is for controlled foreign corporations, to create the transition tax. And again, we have this really complicated legislative language, accumulated post-1986 deferred foreign income. Okay, so what's that? Well, we're going to measure that as earnings and profits, another defined term, that are accumulated after 1986. So we're going to have to go all the way back to 1986 and figure out what our earnings and profits were, and we get to make a couple of adjustments. The adjustments are basically we get to pull out anything that's already been taxed by the United States. Okay, and like any good carpenter, we're going to measure twice. We'll take the larger of the two, right? So we've done that. Earnings and profits, though, what's that? Earnings and profits, we're going to treat it as book retained earnings, but it's not exactly book retained earnings. And the reason is that the U.S. tax code requires you to use U.S. accounting standards and tax accounting standards, not the normal book standards. And then we're going to compute that in our functional currency, but we're going to have to change it to U.S. dollars because everything on the U.S. return has to be in U.S. dollars.
Karen, do you think it would cost a lot of money for for somebody to comply with this?
Yeah, I think so. I think it would be a lot of accounting fees to actually come up with a real earnings and profits number.
Do you think this is the kind of thing that your average U.S. tax preparer could even do?
Probably not. Probably you're looking at a big firm which charges big bucks to get it accurate. Now, the question of whether it needs to be really accurate or being within 5 to 10% is going to be good enough. But if you want it accurate, you're going to be going to an expensive firm. Okay, so that's how much, and that's the gross inclusion into our taxable income. But then to get the rate down to what they call 15.5%, we're going to get a deduction. Okay, so that's going to tell us what rate to pay. And remember, the larger the deduction, the lower the tax rate, because there'll be less taxable income included. So we want to make sure we pay the right rate on that $100 billion we've stashed in Ireland, like Apple has, right? So here's, again, not plain English. So it's based on liquid assets, cash, accounts receivable, accounts payable, and we're going to use the market value of those marketable securities and short-term debt. Now, when we calculated earnings and profits, we used retained earnings, which is book value. What's the difference? The difference is that the book value is not including the unrealized gains. Here, we're going to include all those unrealized gains. So not only are we doing a pretend transaction that's never, no cash is actually changing hands, but we're going to pretend that your marketable securities are worth their total value, including all the unrealized gains that would not have been taxable anywhere yet. And that means that cash that we're going to measure can actually end up being higher than the deferred foreign profits that are supposed to be taxed. And if that happens, what that essentially means is that 100% of your subpart F inclusion is going to be taxed at the higher rate.
For people who are using these things as private pension funds, I mean, I keep coming back to this, okay, because, were this to apply to Canadian control, there's no doubt, okay, that this is simply the confiscation of the pension plan.
So,
I mean, they'll call it early payout, right? But the point is simply this, all right?
Well, the problem with an early payout is that you've taken money that was invested tax efficiently and pulled it out so that you're no longer investing tax efficiently with that money.
Or to put it another way, you lose capital that could be used to generate income for retirement.
Right. So for those of us that like equations, we can compute our deduction as 55.71% of the cash and 77.14% of the balance. Okay, that's going to be added as a subpart F inclusion. You add the inclusion, subtract the deduction, all on your 2017 tax return if everybody's a calendar year taxpayer. And if you're not a calendar year taxpayer, the way they've written it, the percentages will change, and it's a mess, and you're going to need help. Okay, let's put some actual numbers here to it. Okay, that's 55.71% of cash basically means that 44.29% of the cash is going to be added to your taxable income. That's the gross inclusion less the deduction.
And taxed at presumably the highest marginal rate.
And taxed probably at your highest marginal rate because it's going to be a lot of cash, a lot of taxable income. It's going to push your marginal rate up.